This is the best day of the week. I'm so excited. I've been waiting for this all week. We get to drop another Bitcoin Macro War Room episode. What a crazy week this week. We pumped, we dumped. It's Bitcoin, baby. This is what happens. Without any more intro fluff, let's dive right into it. We're going to get into the data. But first, we're going to start off with the chart. So the main thing that happened this week was we had a little pump in the beginning of the week. It almost looked like we could potentially close this air gap with global liquidity. At the peak here, the gap was 17%. So we were closing in, everything looked good. And then one print on Wednesday derailed everything. I think the only other important thing to note here is that liquidity has sort of rebounded, or the forward-looking picture for liquidity has rebounded. So if you look up here in the top portion of the chart, this is the Global Liquidity Index. This is free on TradingView, by the way. If you're interested, you can kind of use this yourself. Anyway, we had this scary dip back down to the EMA, and we have since rebounded and have pushed higher. So the average is somewhere around here, and that's a good sign, right? Rate of change for liquidity is still higher, which means higher prices for Bitcoin. But again, this air gap still exists. My regime tracker down here cooled off a little bit, but it is still in this box. It's still in the zone. So I think everything kind of looks good. It's a choppy type of month. August is seasonally not great for Bitcoin, although I don't put too much stock into seasonality. I use that more for TradFi stocks because there's so much more data. For Bitcoin, there just really isn't enough data to make it significant enough for me. But anyway, that's pretty much it for the charts. And we can dive into the most important stuff this week, which is the data releases. So for the data releases, we had a lot this week. I think the biggest thing that happened was yesterday on Thursday, we had the PPI released, which blew out expectations, right? 0.9 against 0.2. I mean, you can look at the chart itself, and this was a super hot print, and that made everything kind of sell off yesterday. But we'll get to that. We'll start with the CPI, which came in line with expectations. Again, core CPI just strips out food and energy to show underlying inflation trends. It matters because the Fed does watch the core readings more closely than the headline for basically their policy moves. CPI, again, came in at expectations, nothing crazy there. And year over year, headline inflation rate did drop 0.01%. It sets the bigger picture narrative on whether inflation is sticky or fading. So a flat and slightly softer headline feeds into the narrative of rate cuts later this year, which we'll get to right after this. But again, the main thing was the PPI print, which everyone is talking about. Again, PPI is basically total producer price inflation. And then the core PPI strips out food and energy and measures wholesale inflation for producers. The blowout print, it could spook bonds. It could push yields higher temporarily and drain liquidity temporarily. And you saw that immediately in the price. Other than that, core retail sales didn't really care too much. Retail sales, whatever, sort of came in line a little bit softer. I think the only important thing here to point out, which a lot of people don't really track, or at least I don't see it on my timeline, is the Empire State Manufacturing Index, which had a blowout print. This measures manufacturing activity in New York State, and positive readings mean expansion. Obviously, negative means contraction. A huge beat here basically shows strong manufacturing momentum, and that's great for growth. And that's potentially great for the ISM print next month, which is something I track heavily. So you can see it's trending in the right direction, given the historical readings. And I think that actually sets the bullish undertone going into the rest of the year. And that's pretty much it for the data. I think next week, we'll see what we have on the agenda, some FOMC meeting minutes, which will be important. Waller is going to speak, so we'll see what they say. Then you have unemployment claims, the Philly Fed manufacturing, which will be important, and both PMI prints on Thursday, which will also be important. Then they have Jackson Hole on towards the end of the week next week. So that'll be interesting as well. So next week should be a decent data week, and we will move on to the Fedwatch numbers. So let's see what actually happened here. this hasn't really changed. It took a dip back down into the 80s earlier this week after the hot PPI print, but it has since come back up. So the probability of a Fed rate cut on the 17th of September, which is less than a little bit more than a month away at this point, is 92%. So it's basically a shoo-in that there's going to be a cut for October. Again, this didn't move too much. 41% that it'll stay after that, and 55%, so more than half of the probability, is for another rate cut. And then out into December, there's even a probability of going down to 350 to 375 in terms of rates. And again, the probabilities chart hasn't really shifted since our last video. So that pretty much is what it is at this point. And we can get into some of the tweets, which is the fun news section that I like to do. So I did want to point this out because I get this asked a lot, and Quinton has some great takes. So if you're not following him, definitely give him a follow on X. And I'm not going to read the whole thing, but I'll kind of summarize it. I believe the 4-year crypto cycle is dead. There's absolutely no reason to assume this length will continue. The Bitcoin halving was the trigger and built-in mechanism for this to play out. But since the BTC halving has no impact anymore because of the low circulation change and the huge volume, I think it doesn't stand anymore. Longer cycles would also fit better in a mature market, which we are nearing to become. Also, I think there will be a macro top for all financial markets near the midterms of next year in November, et cetera, et cetera. He goes into some political stuff. I completely agree with this. The quote unquote halving cycle that everyone used to track, that is dead. That no longer matters. You have traditional finance, banks, nation states, Bitcoin treasury companies all catching a bid for Bitcoin. We are not going to be looking at the halving. I don't look at any of those metrics at all anymore. And I don't think it matters going forward. I'm more aligned with the business cycle and the global debt refinancing cycle, which I'll share a video towards the end of this section about that specifically, because the sitting president basically said the quiet part out loud for that. So anyway, good take. Let's get into the next tweet from the Kobesi letter, or Kobesi, however you say it. Risk appetite among professional investors is surging. Institutional investors' equity allocation rose to 55% in July, the highest since the early months of the 2008 financial crisis. Basically, all the hedge fund managers were late to this parabolic recovery from the lows in April, especially in stocks, the V-shaped recovery. Everyone was on the sidelines and still net short. And there's other data saying that most of them are still short. They have to deliver for the end of the year. Their bonuses are on the line. So you could see them capitulate to the upside for a further squeeze, and the melt up might continue into the end of the year, which is my base case. Anyway, another good take. This is a great account to follow. I had to throw in a meme in there just because I don't want this to be too boring, too analytical. When you hold more Bitcoin than 99% of the planet, everyone is stupid except me. This is how I feel a lot of the time. If you've ever tried to talk to family, friends that don't know what Bitcoin is and try to explain to them, you can kind of tell how early we all still are in this game. Yes, banks, yes, nation states, yes, treasury companies, but your average person, your neighbor down the street, most likely does not hold any Bitcoin. And if they do hold any crypto, it's usually something where the monetary unit is very cheap, something like Dogecoin or some other meme coin, because of the notional value, right? They see that it's $1 and they think, ooh, this could maybe go to $10. I'll buy it, right? There's no understanding of market cap or anything like that. So most people don't own Bitcoin. Most people don't know you can divide it into X amount of places, right? You don't need to buy one. You can buy 0.000001. Anyway, I think we're still early. That's the signal for that one. Same thing here, same sort of metaphor. Less than 1 million people own one full Bitcoin. That's just 0.01% of the global population. It's hard to get to 1 BTC these days. I would say it's moved over a little bit. If you can get 0.1, you are ahead of 99% of people. So that would be the goal. Peter Brandt here with a great take. This is the sort of overarching macro theme for me that I always keep in the back of my head. The chart that you're looking at is the purchasing power of the US dollar. The ultimate store of value will prove to be Bitcoin. It is deflationary in nature. coins are lost, never touched again, etc. There's only going to be 21 million. There's not even 21 million available anymore because of sort of everything that's happened over the years. But this is the long game. This is the end game. So that's the kind of summary for that one. And Decode here, definitely give Decode Jar a follow. He's amazing, beautiful charts too. The 4-year cycle measured on the previous 2 cycles will lead many to believe it's all over in October. I've seen this all over my timeline where people are calling for a top before the end of the year. I think they're going to be in for a rude awakening and they're going to be sidelined for the actual move. My forecast for when we peak has actually moved out a little bit, and I'll get into that when we get to the system spreadsheet in a little bit. So he writes, I think those people are going to be wrong. We might get a forced local top, but Q2 2026 is the most likely projection for a cycle top based on the macro work I've been doing. And I completely agree with this. And based on my work, I have the same view. I actually think it might be later now than Q2 2026. And we'll actually dive into that right now. So we'll take a look at the weather forecast, 98% risk on. We were 103% risk on last week. The only thing that changed is, again, the regime tracker down here. If it's not trending up, I take off half a point. So that's why we're basically back down to 98%. But again, we still are completely risk on. You should be fully allocated if you aren't already. DCA in. The cycle peak estimate, I haven't updated this on the sheet, but I'm leaning towards this being more like Q3 2026. This is going to be a weird cycle. The ISM, as we discussed last week, is still under 50. The longer that stays compressed, once it does break out, you better strap in. You better buckle up. You better put on like 5 seatbelts because it's going to be wild. So anyway, the rest of the system stayed the same, and we can take a look at some of the actual on-chain metrics. I'll move my camera here so you can see it. The IFP, this is the ongoing same thing it's been since I started this show. It is still bearish. So that's still bearish. That hasn't changed. We can actually take a look at it a little bit closer. Yeah, we're nowhere near having these lines crossed, so this is still going to be bearish for a little while. The bull bear market cycle indicator is still bullish, and that has not changed, which is a good sign. The MVRV Z-score, bull versus bear market, still bullish, still green. That has not changed. Sharp ratio has kind of come off a little bit, which is good to see. Adjusted Nupal, same thing, still yellow, no changes there. Adjusted MVRV, again, no major changes there. Long-term holders seem to be maybe picking up a little bit of a bid here. If I can zoom in on this just slightly, I think the selling could be over soon, and we'll see sort of retail sell the bottom and long-term holders will start buying again. But we'll see if that actually plays out. LTH SOPR has cooled off significantly, which is a really good sign. The market cap change for US kind of staying where it is. Nothing really of note there. UTXO supply ratio momentum has kind of seen a little bit of a spike, which is good. These are usually near local bottoms, so that's a positive. Retail investor demand has completely fallen off again, which is really great to see. That just makes me even more bullish. We're back in the red now. Retail generally sells the bottoms and buys the tops. So again, a good positive sign. Realized price, again, still bullish. Nothing crazy there. Nothing to glean here. The smart DCA, again, did a great job. If you are not fully allocated yet and you want to look at one indicator to figure out when to DCA, this would be the chart I suggest. Again, just a note here, this is only to be used in bull markets. In a bear market, you'd basically be buying all the way down. That's not what you want to be doing. And then sharp ratio short term, same thing, has spiked kind of back up a little bit, which is fine. OTC desk balances have dropped to 142,000. So insane. If we do get a supply shock, watch this chart. It'll be when this chart starts to go under 100,000. So definitely keep an eye on this. And that's pretty much it for the on-chain data. Again, we are risk on, super bullish. Nothing has changed in my opinion. This whole PPI print in my sort of lens is just noise. The Fed is late. They're going to have to cut. They're going to have to cut aggressively. And I did want to share one thing. And again, I'm not going to talk politics here. I don't care about politics. Just take a listen to what the sitting president has to say about the debt rollover.
You go. And I think it's just grossly incompetent, but not quite as incompetent as his decision not to do interest rates, take down interest rates, because just like they shouldn't have taken down a ceiling, they should take down interest rates. Every point costs us $360 billion a year. Think of that, $360 billion for 1 point. And we should be down at 1% because we're the leader of the world. We were always the lowest interest rate until like a certain time ago, decade, couple. But we're always, because we were the United States of America. So even if the country was run badly, we were considered like to be super prime. And now he's got us in a bad place. So we're paying $360 billion a year for each point. Now, I believe we should be 3 or 4 points lower. So that's over $1 trillion we pay every year in interest. And it's really just a paper calculation. You sign a document and you save almost $1 trillion because that number equates very much to the bonds that we have to buy.
Right there, he just said the quiet part out loud. That number equates to the bonds we have to buy. They have to roll over the debt every 3 to 4 years. Why every 3 to 4 years? Well, because that is the general maturity of the debt. So they have to roll it over. And if they rolled it over with the rates being at the current rate, that would balloon the interest payments to obscene levels. He literally just told you that they want 1% interest rates. I think as soon as Powell is done with his tenure here towards the end of the year, he will be replaced by someone who is a sycophant in terms of dovishness. We could potentially see them cut 100 basis points in one swoop. And there will be short-term volatility. There could be a sort of sell the news event. But I think what most people are missing that I've seen on my timeline, every time they start cutting, that's when the cycle is over. That's when everything goes down. I don't think that's the play here. That was historically only true when we'd be cutting into a recession. We're not in a recession. ISM is still below 50. The business cycle has yet to pick up. I think once they start actually cutting rates, that is going to propel us even higher. So that's my take. I think that was a very telling answer. And if you understand what he's saying, you're ahead of 99% of the population in terms of understanding how the actual cycle works. So I hope that at least helped you a little bit. Again, if you made it this far, thank you so much for sticking it out with me. If you did enjoy the video, I'm not even going to ask you for it. You know what to do. I'll be back next week with another Macro War Room breakdown. I love doing these. So thanks again so much for watching and have a great weekend.